Faber talks about the potential for a market crash and has some strategies on how to mitigate that. Look, I'm a huge fan of old Meb. I've followed his podcast pretty much religiously a few years back. I don't have the time to listen to it anymore. There's only so much content I can consume in one day, and investing podcasts they kind of bore me thin again. If there were an investing podcast, I'd listen to Meb's. I still got them on my list of things to listen to, but I find investing podcasts boring because at the end of the day, just buy the index and be done with it. All right. But BSMA, big fan of Meb. And so a number of you had emailed me about Meb's recent podcast. I haven't heard it, but then I got this email in my things. I've subscribed to Cambria's website or email list. I used to own some Cambria. I just got rid of everything because I have VTV, VTI, and VDIGX now, and that's it. So I got rid of everything. I just own those stocks, no, those ETFs. All right, so let's. All right, so here's the email we got. Meb says, we've spoken at length about our concerns about rising U.S. stock valuations. The U.S. stock market long-term 10-year CAPE stands at 38, the second highest level outside the peak of the internet.com bubble. All right, so what Meb has been talking, a lot of people have been talking about CAPE for many years. In fact, I just refer back to this book right here, Ed Easterling, Probable Outcomes, Secular Stock Market Insights. I was reading this book and right around Easter of 2011, we had taken a trip from Texas back to to Phoenix for a week to spend a week's time on the Squaw Peak Resort, like the Hilton Squaw Peak Resort. I'm sure they renamed it because that's such an offensive word. I just remember sitting by the pool, watching my kids in the lazy river and reading this book. All right. So what exactly is the CAPE? Well, the historical average for price to earnings ratio is approximately 15.5 for the adjusted 10-year averages based on Shiller, the cyclically adjusted PE ratio. All right, so basically when Meb is saying right now it's at 38, historically it's, so Meb saying it's at 38 and historically it's at 15.5. That's in 2011 too when this was published. So this was from 1900 to 2009. The historical CAPE has been about 15.5, and that was before the last run over the last 11 years. So back then it was high, and everyone then was saying, oh my goodness, is that 22, 23? It's way too high historically. Oh. All right, so let's read we're going to keep reading a little bit, but what Ed talks about. I think Ed has since passed on. So if he has, RIP, and if he hasn't, I'm sorry. It just seems like I recall reading that. The words baseline trend, so the 15.5 baseline PE, should be emphasized because it's not today's earnings that matter. It's the future stream of earnings that matters. When earnings isn't included in a ratio pertaining to stock market valuations, the price versus earnings, there's a critical assumption that the E amount that is included should be representative of the baseline trends. And he gives an example that if you had a stock market had earnings right now at $100 a share and you expected a 5% annual growth compounded, it'd go from 100 for E and the P versus E, 100 to 105 to 110 to 116 to 122 to 141. The trend reflects a constant compounding growth rate of 5% a year in this example. If, let's see. Then for any year, the reporting earnings value should be used to accurately measure the PE ratio. But you can't do that, man. And we just saw what happened last year. We had too high of a PE ratio, and then we had the COVID thing, and then all of a sudden we're in the single digits was a PE ratio. Why? Because it's using the past earnings and today's prices. So one thing was constant, which is last year's earnings. One thing was volatile, which is the change in prices. The prices changes all the time. I'll never forget you seeing PE ratios like 8 and 9. So you're like, whoa, we're back in the 1982 PE ratios. It was a short-term thing because it was based on previously year's earnings, which were no longer meant nothing in that 2020 time frame because everything was shut down. Royal Carnival Lines, for instance. Crazy. All right. So let's keep going because there's lots of good color in here. So check this out. If, for example, PE is relatively high, I don't think anyone would argue that, and inflation expected to trend higher over a number of years, the stock market is likely to experience a secular bear market. Interesting. That's where Meb and lots of others. Inflation's, the PE ratios are high, and inflation is supposed to trend higher. And then interesting. All right. The growth rate of the economy and thereby the growth rate of earnings sees a ceiling. Inflation and deflation set the range for decline from that ceiling. They're saying basically if we have earnings growth that doesn't keep up with inflation, then the prices will drop accordingly because of the bear market that's to come if we have those earnings growth. Then let's go. Hold on a second. What a knucklehead. I love that dog. PE, price earnings ratios, reacts to the inflation rate. As a result, PE must be viewed in that context, that when the inflation rate is relatively high, investors should expect the PE will be naturally low. At low inflation, a fairly valued PE will be high. Interesting. At low inflation, a fairly valued PE will be high. And what is happening now? We have low inflation, a high PE, but a fairly valued PE should be high because inflation is low. And on top of that, the interest rates are low too, with no reason to think they're going to go up anytime soon. All right, so let's keep reading what Meb says. I just pointed out because everybody and their mom been talking about the CAPE ratio for years, decades. And they've been wrong. Doesn't mean they can't be right, broke clock and all that. But at the end of the day, even Schiller himself readjusted his CAPE because he recognized he wasn't taking into consideration the low interest rates. You have competing assets. All right, so let's keep going. If the stock market goes in a long-term bear market, which is totally normal, they happen, what could you do about it? First, investors don't have to take the risk in the first place. If you're owning about too much risk in stocks, somebody don't own so much. I completely agree. Oh, boy, this guy. You know how you got dogs and squirrels? That's literally him. He sees squirrels outside. He's like, let me at them, Dad. Let me at them. All right, second, you can diversify your portfolio across other asset classes like foreign stocks, real estate, bonds, commodities. Now, historically, adding fixed income has done a great job to help mitigate losses. When the U.S. stock market peaked at the bottom of the peaked in the dot-com bubble, bond yields were 5%. Far cry from today, though. Yep. Third, investors can tilt towards active strategies like value and trend following. We've spoken at length about this, and one of these I actually own. I own Mom or whatever it's called. After addressing the first three items on our what investors can do, lastly, investors can add tail risk strategies. We've covered tail risk in U.S. stocks extensively over the years. Investors can find out more in our old white paper, worried about the market. Might this be the strategy for you? Cambria tail risk tail. Yeah. There's no doubt in our mind foreign stocks are cheaper than U.S. stocks. At the end of Q2, the average foreign developed country CAPE ratio is 24, and the average foreign emerging market company is 15. Both are materially lower than the U.S. at 38. But here's a problem. If the U.S. stock market goes through a long bear, will foreign stocks be immune? No. During the past two bears, the U.S. Foreign and emerging markets declined just as much as U.S. stocks did, technically even more. So despite being a big bull in foreign and emerging markets equities, we're aware that if the U.S. stock market goes down, foreign markets will probably not be flat. So we have a global tail risk strategy as well. FAIL is a natural complement to our U.S.-focused tail risk ETF, FAIL, which is foreign tail. So anyway, that's interesting to me. So let's see if we can't click on the tail risk ETF here and just see what this is about. No, I'm not saying you should buy it. I don't own it. I'm not saying you should buy it. You figure that yourself. It hasn't come out yet. Okay. Has it come out yet? Oh, yeah, it is. All right, sweet. They got, let's see. Do we have any, how long, this hasn't been around long enough. It's only got 21 holdings. My man Mebane, right? ETF lineup. I think they just buy other ETFs. I can't remember what the one I owned was. They invest, all right, Cambria Trinity. All right, so he's buying other Cambria ETFs. I don't know the first thing about it, and like you can buy it if you want. I'm not saying do or don't. I'm not saying that at all. They got $328 million in there. Wow, that's pretty good. Actively managed expense ratio is only 0.59, but does that include the other ETFs that are in there? I just don't know. They only got 3 years. That's my problem. You don't have a huge time frame. Let's look at. I guess we just looked at that. He had the one Mom or something like that. That's what I had. Let's go back to Cambria. Our funds. Let's see. We had the The one I own. There's a Trinity. Toke Cannabis. Right here, GMOM. I like the global momentum. Trends and momentum makes, I mean, I'm 100% convinced, like Meb, that there is a huge market for trends and momentum. And you want to be careful of that, but because the trends and momentum can make you a lot of money, but they can crush you as well. Let's just see fun fact sheet. Yeah, so that's only 6 months. Yeah, 5 years. So we don't have enough real time to I don't know. At the end of the day, I completely agree with Meb. If having too much stocks makes you nervous, the simple solution is not to have so much. Literally, it's just that simple. Anyway, I'm not all that concerned about a high PE ratio. I just am not. And I'm not all that concerned that foreign markets have low PE ratios, thus you should add assets to foreign markets. I mean, you can. I don't care. I don't have any foreign markets. I don't, because we know what happened in 2000, 2008 as well. They all fell just like the U.S. did. I think the large cap values, my predominant asset holding, VTV, is underwhelmed relative to growth. And as such, that's my biggest position. And if you look at 2000 and again in 2001, large cap value actually went up because the growth got smoked. And what else went up in 2001 and 2? Oh, government bonds. What else went up in 2008? Oh, government bonds. So that's why I advocate Ginnie Mae. So if you're worried you have too much stocks, buy some Ginnie Mae, for heaven's sake. But other than that, you can buy these strategies. There's not enough time to see what they did. That's my concern. And here's the thing. They might have done X in the past. Will it do X in the future? I don't know. So if you have too much stocks, there's a simple solution. All right, love your thoughts. We'll see you.